don't ever see any kids, right?
You did not see the bus.
How can you not see a bus? How can you not see a would have been the cherry on top of the things he's talking about. He could have been.
Well, the best part of the conversation though is typically true. He said, well, do you have any video?
Nice to meet you.
I just so happen to have some video.
What did he
Here's
say?
my address. You let me know when you want to come down and watch it.
Thank you. He said, oopsie.
Derek's gonna be
Every
here.
time it's just an
How
awkward
long
pause.
will
Oh, but the bus drivers, we do surveys about every 90 days. Most of whom are school teachers. I did not know that.
Yeah.
They say they've seen a real improvement since we started the program.
Good.
So that's the goal. It's to keep the kids safe, and I think together we're doing that.
If you get to be a pet at the table.
Hot Springs, that happened, they had a kid
Got hit?
Christmas and New Year, and
New Year, Christmas. How about you?
Picture,
Yeah, great.
screenshot
Just
of
didn't laugh
video
long
of
enough.
guy passing the school bus.
it always
He goes,
is.
I'll talk to him tomorrow. I was like,
If you don't have that one figured out yet, I mean, there are certain, but you know, people, when we have to do traffic counts, like we would, like for an intersection, a lot of times we would team, you know, or a roundabout or a light, and we'd sit there and have to click the, and watching the people that will navigate a roundabout or a red light like this on their phone and just, I'm like, I'm like, I don't know how you, I'm
On
not,
the school zone,
yeah, it just,
right after they drop off their own children.
and yeah, then you go to the college though, and they're walking across the street like that, and I'm like, maybe I'm getting of a different generation. I have to stop, get my phone out, text, put it away, and walk, or I will. I mean, I don't know how, I'm not coordinated enough to do that.
me neither.
You're getting older, you're acting like your parents, really, is what you're doing, like that commercial that.
The things that you think, like, you know, I guess I've got young kids now, so you hear yourself still saying things like, wow, that sounds
Really
just
does
like
come
my
around,
dad,
doesn't
you know,
it?
like, that really, you know.
I guess we are all here, and we are recording since the red light's on. So I'm gonna go ahead and call the meeting to order. First of all, I would like to welcome Neil Reed, our new member. He replaces Finley. Do you know everyone here? I know Pat's introduced himself.
And I introduced myself, so.
I'm Derek Cox.
Yeah.
I work with the Parks and Recreation Department.
Nice to meet you. Nice to meet you.
And this Charles Finkenbinder, Cody Arnold. You know Cody. Sort of, kind of, made
Yeah, I think we
kinda
met
like me.
maybe a while when I first started, we came home.
Anyway, we're happy to have you on board.
Thank you.
I sent out the minutes of the December 8th meeting electronically. Did everybody receive a copy? If there are no changes, I would entertain a motion to approve the same.
So moved.
Second.
Derek and I will handle that.
All in favor?
Aye.
Motion carries. I am going to turn it over to Pat since he's here for the financial report.
Okay.
You be first on the agenda, so you can go ahead and leave if you don't want to stay for the rest of the
Very
meeting.
good. I appreciate that. I appreciate that. Good to be with you. I'm here quarterly to do a report on the investments of the plan. And so we're going to be talking about last year and then kind of looking through the lens of some things that are happening this year. I'm going to start with this. I think the page number is out, but the blue page, the very first asset classes page. You know, when we invest money, we're looking at different, what we call asset classes, and that's just different pieces of the market. And so this is a snapshot of what the pieces, or some of them, look like for last year. I thought it was kind of interesting the way it was described here. We generally invest in stocks, mostly stocks, different types of stocks, international, US, small, large. and bonds, that's the arena that we are in, but these are other asset classes, like Bitcoin has become an asset class. I'm not sure why they're using Bitcoin per se, because there are over 100 different cryptocurrencies now. And it's a real thing, it's here to stay, and it's gonna be changing a lot, but it garnered a lot of attention last year. It was up almost 60% for those investors. It's fallen back quite a bit in January, but it'll be interesting to see how that goes. Another asset class that did really well was energy. Oil prices went from about $50 to almost $100 a barrel there. So that was a good performing asset class. And we generally own oil inside of stock, not necessarily just the crude part. Commodities did really well. Real estate continues to do really well as an asset class. It's not something that we invest in, but it is an asset class. And then U.S. S&P 500, that's large company U.S. stocks. You hear about the stock market. This is stock market. They're generally talking about this. And it's a measure of 500 different stocks. It was a little interesting year. It finished up over 26%, almost 27%, but the S&P 500 doesn't comprise 500 stocks anymore for whatever reason, just 504, okay? But it is the S&P 500. And the top 10 stocks, so all but 494 of those, accounted for almost half of the return, or a third of the return of the index. So those 10 stocks were up, accounted for about 13% of that return, and the other 494 stocks accounted for 15% of the return. So it was really narrow kind of focus in what you invest in. And so things like Google and Apple, Tesla was one of the very top performers, Moderna was a really top performer, one of those 10. Those are the type of stocks that are in that. And then everything else was considerably less, and even some negative numbers. Russell 2000 is U.S. small cap stocks. We invest in those, up 13.7. That MSCI EAFE, that's foreign large companies in developed countries. You can see up a little less than 8%. And then the other things that we look at are bonds, which are that Bloomberg Barclays and Bloomberg U.S. Treasury indices. Those are both down. And also gold was down, surprisingly, in a year where we're seeing inflation. And then emerging markets stocks that we invest in were down 5.5%. So really kind of an average year in investments, except for that one asset class. And you were invested in that, so it helped the plan. The plan was up, we'll talk in a minute, but it was up about 10% in total for the year. We'll turn to page 2, and when we're talking about investments, we're always talking about what's going on in the economy. And I found this high frequency economic activity chart kind of interesting, and it talks about 4 things. The number of times that we use our debit and credit cards is the gray bar. Hotel occupancy is green. Seated diners, so that's not drive-through or delivery or anything else. And then TSA traveler traffic, which of course is air traffic. And you can see everything was recovering pretty nicely. The only thing that's above where it was when we had this initial correction is debit and credit transactions. Had a really good Christmas season, and people buying things and feeling comfortable about doing that. Maybe because they didn't have anything else to do. But hotel occupancy, seated diners, and traveler traffic is still down below where it was when we started all this mess. And if you look at the far right, look how it's just everything's kind of dropped off in December. And of course that goes along with the Omicron variant of the virus, and those things are going to be closely watched. And I'm not an expert, don't pretend to be an expert, but from things I read, there is a chance at least that this could be over the surge at least sooner than some that we've looked at in the past. So I'm very hopeful about that, and those types of things will improve. So kind of a dampening on the economy while all that's going on. On page 3, labor is a big topic right now because we're seeing some really unusual things in the labor market. One, there's a whole lot of job openings, and this JOLTS job openings measure is job openings and labor turnover survey. So it's a survey of openings around the country, and you can see just that's a complete surge that's only through October. Job openings even higher than that at the end of December. So a lot of unfilled jobs happening right now. And then look at the top right. This is the quits measure, people that are leaving their jobs, and they're calling it the great resignation, a lot of other things too, but a lot of people are just completely reevaluating in their lives and moving from maybe being a restaurant worker and trying to be upward mobile and doing that, or just burnout, or we don't know exactly what all it is, but there's a whole lot about people quitting their jobs. And one of the reasons I can do that is because there's so many job openings. If you want to have a job, there's a place to go. And most of the time, people that are trying, whether you're highly educated or not, can improve themselves in the job market these days. And then you can see layoffs on the bottom right. Employers are scared to death. They're not laying off anybody that they don't have to, because they need everybody that they can be, all hands on deck there. So we're essentially fully employed, and that's good for the economy. If you look at page 4, this is unemployment. So it's kind of the gray line is the unemployment rate. I just want to point out that the 50-year average, we have 6.3% of people unemployed at any time. And those are people that are wanting to work and at working age. And currently, it was in November, it was 4.2%. Now it's below 4% unemployment rate. And so what employees are able to do now is demand higher wages. These employers that have all these job openings, in order to attract somebody to take one of those jobs, are having to raise wages. And we haven't seen that really in a long, long time on a sustained basis. So you can see the blue line has really popped up there, and that's wage growth, which causes overall inflation. That's one of the things that we're working through there. Kind of gets me to the page 5 in the inflation chart. Look to the far right there in the headline CPI, that's Consumer Price Index, that's a measure of inflation. The 50-year average is 3.9%. We've been running at 2% or below for about 15 years. And just today, the December Consumer Price Index came out, and it was right at 7% for the month. So you're seeing it, I'm seeing it. I went to eat with my mom on Sunday, and she was making sloppy joes, and she said, this 2 pounds of hamburger cost $12. You know, I thought, well, I ought to pay more attention. I just go to the grocery store and I just grab whatever I need. Thank goodness I'm able to do that. But so that's the December number, 7%. That's the fastest rate of inflation since 1982, back when interest rates were between 15 and 20% instead of between 1 and 2%. Two of the major components of that are energy prices, gasoline, all types of oil-related prices, even natural gas and food. Those are 2 big components there. So that's probably something that we're not going to see at that rate for a long period of time, but it looks like we're going to have it for a little while. And that affects everybody, because especially lower income, because they're paying the same rate for gas as somebody is that has a high rate of income. It really takes into their pocketbook there. It can do a lot of harm. So why is that happening? Well, there's a lot of reasons that it's happening. The pandemic is one, supply constraints is another, shortages of all kinds, that's another. And so what the Federal Reserve does, our Federal Reserve, is they establish the level of interest rates kind of on the really short end. And their job is to raise interest rates when they want to cool things down, and lower interest rates when they want to spur economic activity. So if you look at this chart, between 2008 and 10, that's really 2009, they went to 2000, took them to zero. We were coming out of the Great Recession. They were trying to spur activity. Got to 2016, and then they thought, okay, things are getting better. We didn't need to get off of zero. And they raised rates through 19, and then everything went kaput from there, and they cut rates to zero again. And they're doing a lot of other things that spur economic activity. They have just said that we're getting ready to raise interest rates in March and probably again in June. Now we're trying to decide whether it's 3 times or 4 times or whatever, but interest rates, at least on the short end, are getting ready to go up, and that's what these numbers are on the right. So instead of getting 0% on a checking account, maybe you'll get 1% on a checking account at the end of this year. So they control that, but the market controls the general level of interest rates. And so like a 10-year Treasury note, a 10-year obligation, which got down to 0.4%, has popped back up to 1.7%. So we're probably going to just see the general level of interest rates increase over the next couple of years. That credit cards, home loans, bank loans, all those things, and then hopefully interest on your CDs and savings accounts and things like that too. Not necessarily a bad thing, but it's certainly a big change. And then the last two charts, I want to talk about the stock market. I already told you what the returns were. Again, I'm focusing on the S&P 500 index. And this goes back to 1996. I've used this chart many times, really in this group. And you can see from 96 to 08, stocks were kind of flat. They went up. The dot-com bubble, they collapsed in the early 2000s. They went back up to 2007, collapsed again. And since that time, we have a period of almost 13 years where the stock market has gone up. Great big bull market. And then look at over here on the far right, the big drop right there in the middle. That's the 34% drop in stocks between the middle of March and the middle of April of 2020. And then we recovered all that, and then look at that line, it's just gone straight up. And so everybody's participated in that. We've done that in this fund. It's been great for stocks, been great for investors. We're just kind of at this point now where we're kind of wondering, we can't continue to go at this pace. And so our view, and many views are now might be a time to not just run for the hills, but to be a little bit more conservative in the things that you do when you're thinking about stocks. And so this is large company U.S. stocks. There are other parts of the stock market that haven't done nearly as well, small U.S., international stocks. So that's one way to still be in stocks, but maybe shift some risk out of something that's done really well. And so we're beginning to do some of that right now. On page 8, the last thing I want to, I've got 2 pages here. Page 8, S&P earnings per share. If you look at these 3 blue bars, the first one is last year, 2021. The next one's 2022, and the next one's 2023. So those are way up, but look at the difference between the 2021 one, the blue bar on the left, and the next two. So the earnings increases are not expected to be the same as we've had in the last couple of years. So that might be a reason why stocks don't continue to go up at the same pace. And profit margins, I just want to show you, we're among the most profitable time we've ever seen in corporate America, really across the world. And then lastly, on page 9, when we're looking at the markets, different segments of the markets, one of the things we do is it too expensive or too cheap? And we're always looking for investment opportunities on the cheap portion. This is the valuation of the S&P 500, and the 25-year average rate is 6.83%, 883 PE, and we're currently at 21.18 times earnings. So in the top +1 standard deviation, which is really near the top. We haven't seen it since the market crashed in 1999. And this box at the top, if you look at the description column and the latest column, that description are just different measures of valuations for the stock. So it doesn't really matter what they are. Just look at the latest versus the 25-year average in every single one. So stocks are expensive and they don't have to crash, but probably we're going to see a time where this segment of the market is not one of the better times to do. So what are we doing? We're rebalancing, which means that we're taking some money out of this segment of the market and we're putting into others. And we're even still investing in some bonds because bonds probably not going to earn much, but they're your anchor when things go bad. And so we'll always keep some of those, but kind of at a low location. Okay, through the riveting part of the presentation, everybody loves about economic charts. I know you look forward to that, but it's my job. I have to come in and talk about those things.
We all learned something.
Yeah, that's right. Okay, good. Okay, good. Well, let's talk about your fund on page 10, and this is the performance. And I guess I would start on the 12-month cash flow on the right. This fund has just exploded in market value, gone from really probably $9 million or so 4 years ago to $16 million now. So that all happened when you guys came on the board and formed this group. So we can just say the timing was impeccable for you to do that.
We'll see how you do.
Yeah. Good luck on that. So you can see the portfolio value over $16 million. And then the returns, these 3 groups of bar charts, the total plan was up 10.8% for the year. It's averaged over 17% a year for the last 3 years. averaged 11% over the last 5 and almost 10% over the last 10 years. So this has been a really good time. Really will help the health of the plan. You know, when you evaluate, is the actuarial report, is that happen for 2021?
I'll have to double check with Tyler.
Yeah,
I
because
believe
I think they're doing it. I don't think we've seen it yet.
We haven't
You wouldn't have
seen
seen
it
it yet. And I think they do it every 2 years, and last year,
I think you mentioned it at the
Yeah.
last meeting.
yeah. So I'm really looking forward to seeing that and seeing kind of the improvement of the overall health of the plan because of what the markets have done. And then bonds, you can see bonds actually, and if you look at the 1-year column, we're really flattish to even down just a little bit, but a little less than the bond market per se. So we're probably gonna see more of that, flat to maybe even down a little bit this year in bonds. And then all these colors on the bottom, the purple are your stocks. So for the year, your overall stocks, which are large US, small, mid, international, emerging markets, we're up 15. You can see all those markets are represented there. So this is kind of a year where diversification, which you gotta do, you control risk by being in different buckets, not all eggs in one basket. The diversification looks a little weird because you have one asset class that was just so much better than the others. But if you think about it, if you diversify, let's just say among 5, you're always gonna have some that are last and some that are first. And so that's what diversification's all about. And then lastly, I like to show you this asset allocation chart because that's the most important thing that shows the returns or the risk of the portfolio. So the cash at 5%, that's just money essentially not earning anything, but it's not losing anything. It gives us the opportunity to buy something. It's currently just under 10% today. So we've begun to sell the large US stocks are down to about 31% today. So we've begun to sell a little bit of that. Put the proceeds in cash, and then we'll probably continue to do some of those, thinking that maybe we're going to get an opportunity in this first or second quarter when the stock market may be weaker to buy some things at cheaper prices. That's what we like to do. You can see your top holdings down there in the bottom. You know most of those or many of those. And we only added 1 stock during the quarter. This is kind of a time where you're not a whole lot of activity. If we see the market go down a lot, you'll see a whole bunch of activity like you did back in 2020. And then I put into your statement, I think Lisa sent you a holdings report. This is the same thing that she sent you, December 31 assets there on the last few pages. I'll pause there. Any questions or things you want to talk about?
Yeah, it's interesting when you looked at this. You showed us about the spending, the credit card and all that, and that kind of fits with our sales tax returns, which were up significantly. Not MP, but just regular sales tax, and I think you're right, I think people were like us, home working on projects, so you had to buy stuff, or you bought from Amazon, or you ate from home, and so you were still spending, but just kind of in a concentrated way.
Yeah.
Right.
Not on hotels or planes or anything like that.
So it's a good thing we get the sales tax
Yes,
off internet
yes.
sales now.
Because we were really concerned when COVID first started, what was that gonna do? Being so dependent on sales tax.
We were all concerned, we lost 22 million jobs in a matter of about 6 weeks. We just turned the economy off and said, you guys go home, 22 million jobs. And so we really worried about what that was going to do long-term to people's spending habits and what they're able to do. It's been amazing. We as a society are better off financially than we've been in probably 30 years. People who have taken the last 2 years as an opportunity to get out of debt. Some of it was you had the stimulus payments, extra money coming in, so they had those kind of things. Getting out of credit card debt. Some of it was they didn't have anywhere to go, so they're spending on a home improvement or whatever. So I don't think really many people thought that things would be, as far as spending would go, or as good as they are now. And one of the reasons is because we as a society are much better off financially than we have been in a long time.
Do you have any sense of, because I think, the other side of that coin is, and you kind of alluded to it, there's no more stimulus payments coming out. You know, we're not underwriting childcare anymore. You know, all those things are gonna start stopping. You know, is that gonna have an impact on, I guess, the activity of the economy and things like that? Or are people then going to take advantage of all these higher paying open positions and go back to work? Or
Yeah, I think
it's hard to tell.
I think you're right in that economic activity has been stimulated from so many places in the last couple of years. The stimulus payments to families. Think about the trillions of dollars our government has borrowed and distributed in that way. That's just money that's gone into people's pockets. All of that is getting ready to be pulled back gradually, pulled out of the market. We're not doing that. Federal Reserve is pulling back. They're not buying bonds. Interest rates are going to go up. So I think all of that means at best our economic activity is going to be muted. And the Fed is they're kind of in a balancing act because they don't want activity to get too hot, because when you get too hot, you have inflation, and that cuts into their spending power. But they don't want it to get too cold either. So I think we've got a kind of a rebalancing effect going on now, and maybe it won't be that great for the next year or two.
I'm
That's
glad
one
I'm
of the
not
reasons
making
to
those
stop.
decisions.
Pardon?
I'm glad I'm not making those
Me
decisions.
too. Me too. I just report on it. I say, go, yeah. But I support what they're doing. They can't continue, just from an academic standpoint, they can't continue to do, I'm talking about the Fed per se. I think there's room for the government to spend money on people and projects. I think there's plenty of room to do that, always.
Yeah.
But the Fed's got to get out of the way. Let the markets do what they do.
Well, that's a great report.
Yes, I like these kind of reports.
And I like the context things, because that helps me
It's really-
personally, but also
Yeah, lots of good
for the
information.
city also.
Good, thank you.
We
I really
appreciate it.
appreciate your business.
We appreciate it. And does anyone else have any questions, Pat?
Thank you for your invitation to stay, but I'm
So do you have to go to Little Rock, or are you staying here?
I'm through for the day.
Ah, good for
Yeah,
you.
so I think I've
It's a
got
beautiful day.
a couple of honeydews this afternoon.
Good for you.
So that, look for it. Beautiful day, yeah. Thank you, appreciate y'all. See you in a quarter.
Thank you, Pat. You came in through the front.
I did, I can got to learn all about
Pat quarterly comes and presents these to us, and then each month he usually sends me an update electronically, and I send it out to all the members, so we have a chance to look at it. It's a learning curve. I'm
And-
still-
I enjoy his,
I do too. It really does.
beneficial.
Very informative.
Helps us
Very.
understand it. And one of the key things I think that we kind of monitor also is the availability of cash to make these payments.
Mhm.
You know, whether people are starting their retirement and getting the pension, or if somebody leaves and wants to be cashed out. That's kind of one of our jobs, is to make sure there's cash. And I don't think we've had to pull much. We pulled a little bit last
We
year.
pulled a little bit last year, we may this year. The good side of us having to pull cash out is it helps the plan in that it reduces, if they pull all their money out, then we're not gonna be paying them retirement benefits for 30 years.
And that's where the actuary report, and you know, Lisa, and I'm happy to do it after we get that, or unless Tyler wants to do it, but to give an update to the full council.
Yeah, that will be, I
You know,
think they did that, we
I
did
think
that
so
2 years
too,
ago.
and then include, you know, maybe the December quarterly statement.
Yeah, I think either you or Tyler should do
Yeah.
that.
Yep.
Tyler,
Happy to.
either you as the council
Representative,
representative
or,
or
yeah, either
Tyler
way, or
as the
just,
CFO.
I'll email, Felicia and just have her be on the lookout for it.
Okay, yeah, I haven't heard anything about
I
it. It's
haven't
gonna
either. I
come
mean,
up.
like I said, we talked about it last meeting, but
Of course, there's a lot going on the first month
Yeah.
with finance, so, and payroll.
they're busy.
Okay, well, the next item on the agenda is the refunds, and we have 3 this month. We have Alexandria Lindsay for $5,300.42. Mike Cullum for $6,072.24. And Darren Tyler for $18,222.54.
Any of them old plan?
Darren, part of Darren's was split. Well, no. He was,
Old plan,
he was new
new
plan.
plan?
New plan. Part of his was post-tax and part of it was pre-tax, but yeah, there was none that were, all of these were came on board after 2018, so. The total amount is $29,595.20. And finance verified it to make sure the amounts were correct.
Make a motion to approve.
Second.
All in favor?
Aye.
Aye. Okay, the next item on the agenda, I have a retirement. And the only retirements that come to this board are those in the non-uniform plan. All the police and fire department retirements are in lot fee, so they do not go through this group. Robert Gary with the Parks and Rec Department wants to retire effective the 24th of January. He is eligible. He's started in 2011, and his birth date was 12. Anyway, he meets the age requirements without putting his age out there for everybody. His monthly gross retirement amount will be $1,148.20. And his first check will be prorated in February. Since he'll
Motion to
have,
approve.
Second?
all in favor?
Aye.
Aye. All, motion carries. And does anyone have any new business?
I think that's it.
Entertain a motion to adjourn.
Motion to adjourn.
Second.
All in favor?
Aye.
Okay, thank you all.
Thank you, Lisa. Left Peter home with granddaughters.
I beg your pardon?
I left Peter home with granddaughters.
Oh.